Most people waste years picking stocks when one simple ETF could have made them more money with less risk. Here's the truth about ETFs versus individual stocks. In this video, I'll break down the difference between ETFs and individual stocks, show you which one actually builds wealth faster, and how I personally combine the two in my own portfolio. By the end, you'll know exactly which strategy fits you best. Most people are wasting time picking stocks, but what's the alternative? Let's start with ETFs, one of the easiest ways to grow your wealth without the need for picking winners. Think of an ETF as a basket of investments. It could hold stocks, bonds, or even commodities. And just like a regular stock, you can buy and sell it on an exchange through your broker, instantly giving you diversification with just one transaction. The price of an ETF fluctuates throughout the trading day as the value of the assets within the ETF rise and fall. If you invest in an ETF, you get instant diversification across the whole market. You've got exposure to multiple companies and sectors within the economy. This diversification makes ETFs a much more passive and uninvolved investment strategy, much better for beginners. The returns are also consistent. If you invested in a broad market index fund like the S&P 500, your money would have on average grown by 13.2% each year. 10,000 invested in 2015 would be worth about 35,000 today. Now you might be thinking, can't mutual funds give you the same diversification? And technically they can. But here's the difference. Most mutual funds charge much higher fees. They're less transparent, and the majority don't even beat the market long term. To make this concrete, let's say I have 100,000 to invest for 20 years, and I expect an 8% annual return. If I put it in an index fund like VU or IVV, which has a management expense ratio of just 0.09%, in 20 years it'll grow to about 553,000. But if I put the same money in a mutual fund with a 2% fee, it would only be worth 321,000. That's 133,000 lost to fees alone. This is why choosing a low-cost index ETF can make a massive difference over time. Index ETFs solve this problem by giving you broad market exposure at a fraction of the cost, with better performance after fees, keeping more money in your pocket. ETFs give you a steady market return, but if you're chasing bigger wins, that's where individual stocks fit in. Sometimes, as an investor, you don't want the whole market. You want to bet on one specific business you believe in. That's the idea behind buying individual stocks. When you buy a stock in a public company, you become a part owner in that company, no matter how small your stake. Companies sell stock to raise money for growth or operations, while investors hope the stock's value rises as the company succeeds. Some companies will also pay a dividend to stockholders. This is just a share of the company's profits paid out to investors for holding their stock. Investing in single companies has some clear advantages. The biggest draw is the potential to massively outperform the market if you pick the right stock. Just one winner in your portfolio can sometimes outweigh several underperformers. Imagine investing in Nvidia just 5 years ago. You would be up over 1,200%. On top of that, many companies also pay strong dividends, which can provide a steady income stream alongside your capital growth. And unlike an ETF, where you buy the whole market, with individual stocks, you have complete control of where your money is invested. You get to decide exactly what business you believe in and what you want to own. But with that upside, there comes big risk. For every apple, there are dozens of companies that underperform the index or even go bankrupt. Picking winning stocks is extremely difficult. Even professional fund managers fail to beat the index long term. Individual stocks are also far more volatile, meaning your portfolio can swing dramatically with market news. That kind of volatility can be stressful and cause emotional decisions like panic selling. Plus, to invest responsibly in single stocks, you need to do the research, keep up with company reports, and have a strong belief in your picks. The reality is, while some investors strike it big with single stocks, the majority underperform the market. If you're new to investing or just want a strategy you can stick with long term, ETFs make far more sense than betting everything on a few individual companies. ETFs are a consistent way to build wealth over time whilst minimizing your risk and avoiding mistakes. But for an experienced investor or someone looking for higher performance, buying single stocks is a great option if you're willing to do the research. A great investment strategy that aims to benefit from having exposure to ETFs and single stocks is a core satellite portfolio. You aim to have 80% of your investments in low-risk, diversified ETFs and have 20% of your portfolio in high-conviction single stocks. This way, your portfolio is still delivering consistent returns, but you also have a potential of catching the upside of a winning stock. For me personally, because I'm in my early 20s and focused on building capital, I keep a larger proportion of my portfolio in individual stocks. That's where I take my shots at the riskier, high-growth opportunities. But I still hold ETFs as the backbone of my portfolio. I think of them as my safety net. No matter how my stock picks perform, I know my ETFs are quietly compounding in the background. This balance lets me chase growth while still protecting myself with a solid foundation. And that's the beauty of ETFs. They can fit into almost any investing style, whether you want to play it safe or go after big wins. If you want long-term wealth, ETFs are hands down the safest bet. But if you're like me and willing to take on a bit more risk, picking stocks can grow your wealth much faster than investing in ETFs. And hey, if this video helped you out, make sure to hit that like button so more people can find it. And subscribe if you want to see more simple, no bullshit investing breakdowns. Drop a comment and let me know. Are you more of an ETF investor, or do you like taking shots on individual stocks? Thanks for watching.